Hey everybody, it's Larry Berman here, and boy is my radar screen foggy this week. But let's dig into the chart room and see what's happening, because there's a lot of stuff happening under the hood that really has nothing to do with fundamentals and has everything to do with the technicals of the market. So what are the technicals of the market? Yes, there's RSI and MACD and all those things and moving averages. And of course, I'm known for a lot of those things. But the technical aspects of the market are also underpinning what goes on with the buying and selling. Everybody knows about the option gamma trades and everything else. And many of you may use this ETF to generate extra yield in your portfolios. Q Yield, QYLD in the US, it's the NASDAQ 100 covered call ETF, and it generates extra yield by way of option premium. Well, it turns out markets know when they're going to trade, so you get a little front running going on. And so every month when these things get rebalanced, there's a tremendous amount of forced buying that goes on. And on Thursday, they had to buy $4 billion worth of the Qs in order to restructure this portfolio. At least that was the story that was going through the market that I heard. So what does that mean? It means an awful lot of dumb money is making buying and selling decisions. And what I mean by dumb is, I don't mean the end investor per se. I mean forced buying and selling for not fundamental reasons, but for technical reasons, meaning this needs to be done because that's what the product says it needs to happen. It doesn't make any of these products good or bad. It just is what it is. So please understand that lens. What that skew has done with this, all this gamma, this forced buying of markets, when we look at the S&P 500. So the S&P 500 went out at 4409.59. So let's call that 4410. When I look at the end of October, so seasonally, October, bad month, risk factors higher, you would expect an at-the-money put for the S&P 500 to trade with a higher premium than the at-the-money call. But what's going on now in the market is that the call is trading at 190-ish. Last trade at 200 there, but let's 190-ish. Where the put is trading at 118 mid. What does that mean? So you've got this massive skew that people are buying calls. They're adding leverage to the market. It's forcing up the big names, the Microsofts, the Apples, and it's not fundamental. It's leverage and it's forced buying. I get the AI narrative might be driving it. Every company comes out and says something about AI. Who was it? There was, I don't know, a food company. Can't remember which one it was. Some nonsensical thing where the CFO or CEO mentioned that they were incorporating AI, and all of a sudden the stock's up 4%. That's how speculative, I'll stop using the word stupid. That's how speculative the tape is today. And there's nobody that can tell you when it's going to end with precision. But when you do the smell test, you kind of get the sense that the speculators driving the bus here. And when it starts to get rational again, that's when you get a halt moment. So let's take a look under the hood. Microsoft, great company, right? Put up your hand if you love them. Well, it's trading at 36.5 times trailing PE. And on a forward estimate basis, 35.6. Let's have a look at what that means historically. Here's Microsoft's historical trailing PE. The median, the last 20 years, and you would argue this is the best of Microsoft's period here, the median for this is 23 and change. One standard deviation, 33, two standard deviations, obviously, and this is going back to 1999. So we're not extreme two standard deviations by a dot-com bubble peak. If you want to go back and take a look at 2000 there, you can see 1999, 2000, how extreme the valuation got. And Microsoft grew into it, right? Where we are today, after today's close, 37 times trailing PE. So, you've got a market that's pretty darn expensive. If you look at it pre-COVID, right there's the peak in February, 35 times. So we're more expensive than pre-COVID. You could argue that the good markets in 2017, Trump tax cuts, playing out, the stock was trading at 25 to 30 times multiple. At 25, it's a pretty good deal. So where it got down to at the lows last year, there was some value. It wasn't cheap, like this cheap. But I wouldn't expect Microsoft to trade at 10 or 15 times earnings, anytime soon again. So you can discount that, as being crazy cheap, and you could call it mid 25s. So what has to happen to Microsoft to get back down to $250, $240, $230? That's kind of where it gets interesting again for me. So I think the leadership, and whether it's Apple, Microsoft, Amazon, Google, some of them are cheaper than others. NVIDIA. So great company, but what are you paying for it? And so again, what is it worth? I don't know. Half of what it's trading for starts to get interesting. Listen, I've been offside on this. I bought it when it was at 110 or 15 down here, when it was trading at 30 times earnings. Okay, and I actually sold it right here when it was trading at 50 times earnings. 200x trailing, yeah, it's going to grow into it. Sure. How long is that going to take? So that's the kind of market we're in today. It's speculative more than anything else. And I can't reiterate enough caution. I was able to put in a condor position where I shorted, it's not really a condor, I shorted a long call spread. Premium there is huge. So I shorted an S&P 4,500 call, and I got paid a premium for it. I bought the 4,600 call, so I paid a premium for that. I netted a little more than $50 doing that. And I used that $50 to buy 3 put spreads from 4,250 down to 43 to 4150. Let me clear. I sold the call spread to buy the put spread, so I'm risking about 2%. And my call is that between now and October, key October period, that we are somewhere back below 4150. How many people put up your hands? Give me a thumbs up on YouTube channel here if you like it. That trade, absolutely free. My maximum risk is 2%. If I win, I'm getting 3x on that risk. So I'm going to make a 6% return with no cost. And in worst case scenario, I lose 2%. How many people like that trade here with this overvalued market and what we're seeing being able to short a call to buy a put? Anyways, I love that trade right here. Seasonality, it makes sense to me. And if we get down into this congestion here again, which probably finds some support initially by October, I'm a happy camper. That's my trade of the week, folks. Have a good one.